For years, the dominant narrative in crypto has been one of opposition. A tale of a rebellious, decentralized ecosystem operating in the shadows, battling against an entrenched and skeptical legacy financial system. The events revealed at Solana Breakpoint have fundamentally rewritten that story. We are no longer looking at a rebellion from the outside, but a transformation from within. The single most critical yet underreported takeaway is this. The regulatory foundation for crypto's seamless integration into the global financial system has been formally and officially laid. This isn't about another money transmitter license or a state-by-state compliance victory. This is a paradigm shift of a different magnitude. During the conference, it was revealed that several major digital asset firms, names at the very forefront of the industry, have secured conditional approvals for full banking charters under U.S. federal oversight. Let me be precise about what this means. A banking charter is not merely a permission to hold assets. It is the master key to the financial kingdom. It grants access to the Federal Reserve's payment systems, the very plumbing that moves trillions of dollars daily. It allows for the direct issuance of loans, the holding of public deposits with FDIC insurance pathways, and the creation of a full suite of credit products. These entities are poised to evolve from being crypto companies into being banks that specialize in digital asset technology. The implications of this shift are tectonic and cascade across every layer of the ecosystem. First, consider the user experience for the average person. The single greatest point of friction, the on-ramp, is about to be demolished. Imagine logging into an app from a federally chartered institution. Instead of a multi-day process involving wire transfers from your traditional bank, waiting for holds to clear, and paying exorbitant fees, you could, with a few clicks, move dollars from your insured savings account directly into a yield-bearing, on-chain stable coin position. The demo shown at Breakpoint, where minting USDC took 5 clicks, is not a futuristic fantasy. It is the direct precursor to this reality. The wall between your bank account and the blockchain is becoming a door, and these new chartered entities hold the hand. Second, this reshapes the entire narrative of risk and legitimacy for institutions. A pension fund, a corporate treasury, or an endowment fund has a fiduciary duty that requires extreme regulatory comfort. The idea of parking significant capital in an entity operating in a regulatory gray area has been a non-starter. A federally regulated crypto-native bank changes that calculus entirely. It provides the legal clarity, the supervisory framework, and the institutional-grade safeguards that these massive pools of capital require. It transforms digital assets from a speculative bet into an allocatable asset class with a clear compliance road. The announcements from Wall Street firms like Galaxy Digital, declaring themselves Solana Maxis and building tokenization platforms on-chain, are not coincidental. They are the direct and logical response to this emerging, regulated infrastructure. They see the rails being built and are now constructing the trains to run on them. Finally, and most profoundly, this establishes a new competitive dynamic for financial innovation itself. For decades, innovation in consumer finance has been bottlenecked by legacy banking infrastructure, systems built on 1970s-era code, protected by moats of regulation and high switching costs. These new chartered entities are not burdened by this legacy. They are building their core systems from the ground up on blockchain rails. They can offer programmable money, instant settlement, and composable financial products as their baseline service. The personal banking screen demoed at Breakpoint isn't just a fancy UI for moving stablecoins. It's a glimpse into a future where your bank account is natively interoperable with DeFi protocols, where you can automatically allocate a portion of your paycheck to a tokenized real-world asset fund, or where your mortgage is a smart contract that can be seamlessly refinanced on a decentralized marketplace. The media largely framed this as Ripple gets a license, but that misses the forest for a single, albeit significant tree. This is not about one company. This is about the creation of a new archetype, the on-chain primary dealer. These federally chartered, crypto-native institutions will become the essential bridge nodes. They will mint the regulated stablecoins that become the lifeblood of DeFi. They will custody the tokenized treasury bonds that institutions use for collateral. They will provide the legally sound off-ramps for the profits generated in the decentralized ecosystem. This is the silent, foundational bomb that was dropped at Breakpoint. The frantic energy around new meme coins and trading features is the visible surface wave, but this regulatory shift is the deep, powerful current that will determine the direction of the entire ocean for the next decade. The battle is no longer for escape from the traditional system, but for supremacy within a new hybrid financial order that is being born, fully licensed, before our eyes. The builders on Solana aren't just coding apps, they are coding the operational software for this new breed of bank, and the conference made it clear that the charter to run that software has now been granted. In the world of high-stakes technology, the most profound revolutions often arrive not with a bang, but with a whisper. At Solana Breakpoint, the ecosystem delivered a masterclass in this principle, revealing a truth that reshapes our understanding of its technical readiness. Its most critical scaling upgrade, Firedancer, has been live and operational on the mainnet for weeks entirely undetected. This revelation is far more than a technical footnote. It is a strategic declaration of a profound maturation, signaling a decisive shift from a period of public beta testing to one of silent, confident production. To grasp the magnitude of this, we must first understand what Firedancer represents. Conceived and built by the high-frequency trading engineering firm Jump Crypto, Firedancer is not a mere incremental patch. It is an entirely new, independent validator client for the Solana network. Think of it not as upgrading the engine of a single car, but as introducing a completely new parallel engine design to an entire fleet of Formula One cars, while they are racing at full speed. Its core promise is threefold: to radically increase the network's transaction throughput, the much-discussed goal of 1 million plus transactions per second, to provide an unparalleled layer of redundancy and security through client diversity, and to enhance overall stability. For over a year, it has been the ecosystem's most anticipated moonshot, the big thing perpetually on the horizon. The Breakpoint reveal turned this timeline on its head. The horizon was already behind us. The future had already arrived, and it was quietly doing its job. The methodology of this deployment is perhaps its most telling feature. The team explicitly stated there was no big bang moment, no grand coordinated flag day where the network shuttered and rebooted under a new regime. Instead, it was a phased, meticulous, and gradual integration. This is the hallmark of engineering confidence, not marketing hype. Focused on resilience and organic adoption, allowing the new client to be stress-tested with real economics the existing client in real time, and to prove its robustness without the fanfare that often accompanies less certain launches. The fact that it processed full blocks on mainnet without causing disruptions or even drawing significant attention is a testament to its stability, a quieter, more powerful proof of concept than any testnet metric could ever provide. This silent deployment must be viewed in concert with the other data points showcased, the network's public uptime and resiliency metrics. The charts presented were not just good. They told a story of remarkable consistency, showcasing almost 2 years of solid green. This visual narrative is a direct counterargument to the legacy critique of Solana's reliability. It evidences a network that has moved beyond its early, public growing pains and has entered a phase of hardened operational maturity. The narrative of downtime is being systematically replaced by a track record of persistent uptime. Firedancer's live status is the insurance policy and the accelerator bolted onto this now proven stable foundation. The strategic implications of this dual reality, proven stability plus a live next-generation scaling layer are immense. First, it fundamentally alters the risk calculus for enterprise and institutional builders. Large-scale applications, particularly in finance, cannot be built on speculation. They require a credible, demonstrated foundation. The combination of a multi-year uptime chart and the fait accompli of Firedancer's mainnet presence provides that demonstrable credibility. It allows developers and institutions to build with confidence, not on promises of future capability, but on the documented reality of present scalable infrastructure. Second, it represents a critical achievement in the pursuit of credible neutrality and decentralization through client diversity. Prior to Firedancer, the Solana network ran almost exclusively on a single validator client software. This presented a single point of failure, both in terms of potential bugs. The successful stealthy deployment of a second independent client built from the ground up by a different engineering team is a monumental leap for network health. It means a bug in one client does not threaten the chain's liveness. It fosters a more resilient and competitive development ecosystem. Look, it is, in essence, the network growing its first major immune system. Finally, this move showcases a sophisticated, almost diplomatic approach to ecosystem management. By deploying Firedancer live, but quietly, the core teams avoided the massive, potentially destabilizing, speculative frenzy that would have accompanied a public launch date. They allowed the technology to speak for itself through performance, not promises. They managed to deliver the single most important technical milestone for the network's long-term scalability without triggering the short-term volatility and sell the news pressure that often cripples such announcements. It was a maneuver that prioritized the long-term health of the network over the short-term dopamine hit of a marketing campaign. In essence, Breakpoint revealed that Solana has been conducting its most important exam in public, and it has been passing with flying colors while everyone assumed it was still studying. The infrastructure is no longer a work-in-progress hypothesis. It is a battle-tested, scalable, and redundantly secure production environment. The engine for the next phase of Web3 adoption isn't coming. It's already here, it's already running, and its quiet hum is the most convincing signal yet that this network is ready to shoulder the weight of the real-world assets, institutional capital, and global user base that its blossoming application layer is now poised to attract. The foundation is not just poured, it is already holding up skyscrapers, and most of us didn't even notice the construction was complete. In the ruthless competition for financial market share, there is one ultimate, non-negotiable kingmaker: cost. Lower costs attract volume, volume begets liquidity, and liquidity solidifies a marketplace's position as the default destination. For years, the decentralized finance DeFi narrative has championed a future of open, permissionless, and transparent trading, but it has always labored under a quiet, embarrassing truth. Using it was often more expensive than the centralized exchanges. It sought to displace. Network gas fees, protocol fees, and slippage created a cumulative cost burden that made sophisticated, high-frequency, or even moderate-sized trading economically unviable on-chain for all but the most dedicated. The data unveiled at Solana Breakpoint signals that this era is definitively over. We have reached the tipping point in the Great Fee War, and the battlefield has irrevocably shifted. The presentation was stark in its simplicity and devastating in its implications. Side-by-side comparisons were shown for identical trades. The result? Executing a trade on a leading Solana-based decentralized exchange, DEX, now carries a lower total cost, factoring in all fees and slippage, than performing the same trade on Coinbase or Binance. Let's deconstruct the profound significance of this. For Coinbase, a trade might cost 12 basis points, 12% plus additional exchange fees. For Binance, it might be 5 basis points. The on-chain cost on Solana, a mere 3 to 5 basis points total. This isn't a marginal improvement or a speculative someday promise. This is a present tense, empirically verified reality. The long-held goal of making on-chain trading competitive with centralized exchange trading, as stated on stage, has not only been met, it has been surpassed. This victory is not a fluke. It is the direct engineered outcome of several converging technological and economic forces unique to Solana's architecture. First is the raw throughput and sub-second finality provided by its core protocol. High speed allows for more transactions to be processed in a given block, naturally diluting the base layer cost per transaction. Second is the architectural efficiency of the Serum Open Book-Derived Central Limit Order Book, CLOB, model that underpins many of its major DEX. This model, familiar to traditional finance, allows for deep, aggregated liquidity pools that minimize slippage. Often the hidden largest cost in an automated market maker, swap-based trade. Third is the hyper-competitive environment among Solana's own DEX aggregators and liquid staking providers. Projects like Jupiter, Drift, and others are in a relentless race to offer the best price execution, creating a market dynamic that constantly pushes efficiency gains and fee compression back to the end user. But the announcement didn't stop at spot trading. The next frontier was clearly marked derivatives. The stated mission is to now bring the same 3-5 basis point cost structure to perpetual futures, options, and other synthetic products. This is where the financial revolution truly accelerates. The derivatives market is the levered engine of global finance, orders of magnitude larger than the spot market. If Solana can replicate its spot fee supremacy in derivatives, it will unlock a tidal wave of professional trading capital. The cost savings for a fund running a high-frequency derivative strategy would be astronomical, transforming from a mere incentive into an existential imperative to migrate on-chain. The implications of this cost tipping point cascade across the entire spectrum of users. For the retail trader, the psychological and financial barrier to entry dissolves. A user no longer has to make a philosophical choice between supporting decentralization and keeping more of their money. The rational economic choice now aligns perfectly with the ideological one. They can trade with self-custody on transparent protocols and save money. This removes a massive friction point for the next 100 million users. For the professional and institutional trader, the calculus shifts from curiosity to hard-nosed portfolio management. On-chain trading moves from a sandbox experiment line item to a core execution venue. The combination of lower fees, non-custodial settlement, eliminating counterparty risk with the exchange itself, and 24/7 market access creates an irresistible value proposition. The demo showing intent to tokenize and trade equity derivatives on-chain at better prices than NASDAQ is the direct endpoint of this logic. For the ecosystem itself, cheap, reliable execution becomes a foundational utility like electricity or broadband. It ceases to be a differentiating feature and becomes a baseline expectation upon which new, previously unimaginable applications are built. Microtrading, real-world asset fractionalization for tiny amounts, and complex, frequently rebalanced DeFi strategies become not just possible, but practical. This is more than a technical milestone. It is a profound market structure event. For decades, financial intermediaries, exchanges, brokers, clearinghouses have extracted enormous rent from the simple act of connecting buyers and sellers. Solana's demonstrated fee structure proves that a decentralized, software-driven marketplace operating on a global public ledger can provide that service more efficiently than some of the most powerful, centralized corporations in the world. The message from Breakpoint was unambiguous. The arbitrage opportunity between CeFi and DeFi pricing has closed in DeFi's favor. The narrative has flipped. We are no longer asking when on-chain trading will become cost competitive. We are now observing the moment it became the cost leader. This creates a gravitational pull that is fundamentally economic, not speculative. Capital and its relentless search for efficiency and yield will now flow to the cheapest, most liquid venue. The data presented proves that Venue, for a growing number of asset classes, is now on a Solana-based decentralized exchange. The fee war isn't just one. It has established a new, permanent paradigm for how financial value is exchanged. For the entire history of cryptocurrency, a fundamental chasm has existed between the digital ledger and the physical world it aspires to represent. We could create tokens called Apple stock or gold bar, But these were in essence sophisticated IU systems, digital claims on a centralized custodian's promise to hold a real asset. The link was one of legal contract and trust, not of technological inevitability. The breakthrough announcements at Solana Breakpoint didn't just bridge this chasm, they installed multiple bidirectional highways with automated tolls. We witnessed the emergence of the redemption interface, the critical operational mechanism where a purely digital token can be instantaneously, verifiably exchanged for a unique physical object in the real world. This transforms tokenization from a financial abstraction into a logistical protocol, and it changes everything. The most profound example came from the realm of tokenized equities. A platform unveiled a feature called Export. Its function is deceptively simple yet revolutionary. It allows an institution, a hedge fund, a market maker, a corporation to send actual legally registered shares of a company like Ford or Apple in kind to a designated custodian. In return, the institution receives an equivalent number of tokenized versions of those shares directly on the Solana blockchain. The reverse is just as seamless for redemption. This is not a dollar-based purchase. This is a direct asset swap. Why is this atomic? First, it collapses the traditional multi-step process of selling a share, wiring USD, buying a stablecoin, and then purchasing a tokenized version. A process riddled with delays, fees, and settlement risk. Second, and more importantly, it creates a tangible, on-chain proof of backing. The inflow and outflow of physical shares are recorded as on-chain events tied to the mint and burn of the tokens, creating an immutable, transparent audit trail that anyone can verify. The token is no longer a vague claim. It becomes a digital twin with a provable one-to-one tether to a specific, immobilized physical share. Simultaneously in the commodity space, another project showcased an identical breakthrough for gold. They announced a global redemption network, launching with 5 physical locations where a holder of their gold-backed token can present proof and walk out with allocated physical gold bullion. This too is processed and verified entirely on-chain. But they went a crucial step further, introducing what they called the first yield primitive for gold. This means the token representing physical gold can now be programmatically lent, borrowed against, or used as collateral in DeFi protocols to generate a yield, a return separate from gold's price appreciation. For millennia, gold has been a sterile, non-yielding asset you pay to store. In one move, it has been transformed into a productive, interest-bearing digital asset, while never losing its link to the physical metal. The yield is the premium for its new digital utility and liquidity. The convergence of these two models, for equities and for gold, reveals a new universal template for real-world asset tokenization. The template has 3 core layers: the immobilization and verification layer, a specific audited physical asset, a share certificate, a gold bar with a serial number, is legally placed into a regulated, bankruptcy remote custody structure. Its existence and details are hashed onto the blockchain. The minting and redemption interface, the export-import function. This is for the frictionless in-kind exchange between the physical asset and its digital token, with every transaction creating an unforgeable link on-chain. This interface is the proof of the tether, the on-chain utility and liquidity layer. Once minted, the token is unleashed into the DeFi ecosystem. It can be traded 24/7 on those low-fee DEX, used as collateral for loans, fractionalized into microshares, bundled into index products, or, as with gold, made to earn a yield. This layer extracts immense new value from an otherwise static asset. The implications of this mature template are staggering. For capital markets, it enables 24/7 global fractional ownership of any asset class. A retail investor in Asia can buy a $10 fractional token of a Manhattan skyscraper at 3 a.m. local time. A European fund can use tokenized U.S. Treasury bonds as instant, programmable collateral in a loan protocol. For corporate finance, companies can issue shares or bonds directly on-chain to a global pool of capital, with dramatically lower intermediation costs. These tokenized securities would be natively programmable. Imagine a dividend that auto-converts to stablecoin and compounds in a yield vault, or a bond with a coupon rate that adjusts automatically based on preset metrics. For the global economy, it creates a unified, programmable ledger for the world's wealth. Illiquid assets, private equity, real estate, art, intellectual property royalties can be transformed into liquid, tradable digital assets. This unlocks trillions of dollars in currently frozen capital, enabling it to be leveraged, traded, and put to productive work. The Breakpoint announcements moved raw discourse out of the theoretical white paper phase and into the operational manual phase. The question is no longer, can we tokenize a stock or a bar of gold? The demonstrated answer is yes, and here's the exact working mechanism to mint it, redeem it, and make it earn yield. The digital token has finally grown a hand that can reach through the screen and grasp the physical object it represents. This is not just finance. This is the beginning of a fully digitized, hyper-liquid, and globally accessible economy of things where every asset, from a share of Google to an ounce of gold to a future invoice, has a live, tradable, and productive digital twin on a public blockchain. The ledger is no longer just recording value. It is beginning to actively manage and distribute the very foundations of the material world. The most powerful signal from Solana Breakpoint was not the roar of the retail crowd, but the quiet, determined unpacking of tools by the institutional architects. The conference marked the end of Wall Street's exploratory phase with blockchain technology and the unequivocal beginning of its build phase. This wasn't about dipping a toe in. It was about laying cornerstone after cornerstone for a new financial citadel, and they chose Solana as their foundation. The declaration from a publicly traded giant like Galaxy Digital, openly calling themselves a Solana Maxi on a main stage, is a cultural and strategic earthquake. It signifies a pivotal shift. The infrastructure is no longer seen as a risky tech experiment, but as a superior operating system from core financial services. We must dissect what, precisely, these institutions announce they are building, because it reads like a wholesale reconstruction of the capital markets stack. Tokenization of registered securities. Galaxy Digital explicitly stated they went to the SEC to tokenize securities, and they did it on Solana. This is the vanguard. They are not tokenizing meme coins or novel assets. They are taking existing, SEC registered financial instruments, likely private funds, structured products, or eventually ETF, and issuing them natively on-chain. This turns a static share certificate into a programmable, instantly settling, 24/7 tradable digital asset that can interact with DeFi. On-chain prime brokerage. The announcement of building a prime brokerage on-chain is arguably the most consequential. Prime brokerage is the plumbing of institutional finance, the service that provides hedge funds with leveraged trading, securities lending, cash management, and consolidated reporting. Building this on-chain means creating a unified, transparent ledger for all these activities. It means a fund's collateral can be dynamically rehypothecated in real time. Its positions can be used across multiple protocols simultaneously, and its risk can be monitored on a global, real-time basis. This is the infrastructure needed to move trillion-dollar fund families on-chain. The Aprop Omni and price dominance goal. The partnership to launch a proprietary automated market maker AM, with the goal of achieving prices better than Binance's, a direct assault on traditional exchange hegemony. Their stated end state is breathtaking in its ambition, that when you look at the NASDAQ price for a stock and the Solana price for its tokenized version, you will want to buy on Solana because it's cheaper and faster. This is a declaration of price discovery superiority. They intend to use the efficiency of decentralized liquidity pools to outcompete the very centralized exchanges they helped build. Institutional-grade issuance and settlement. The hypothetical posed on stage. What if we could issue shares on-chain in exchange for SOL? Cuts to the heart of efficiency. Today, equity fundraising is a bureaucratic marathon involving armies of lawyers, bankers, and custodians settling in days. An on-chain issuance would be a cryptographic event settling in seconds, with the capital instantly programmable and the investor base globally permissionless. This isn't just an incremental cost saver, it's a complete reorganization of corporate finance. The driver of this stampede is not ideology, but an irresistible convergence of economic and regulatory forces. First, the economic imperative of efficiency. The models presented, such as the one from an analyst showing a path to $1 trillion network valuation via tokenization, are not moon math. They are discounted cash flow analyses based on capturing basis points of the multi-trillion-dollar RUA market. The lower fees, instant settlement, and 24/7 markets we covered earlier translate directly to higher margins, better returns, and competitive advantage for these institutions. They are fiduciaries. They are obligated to pursue this efficiency. Second, the newly viable regulatory pathway. The conditional banking charters discussed in Keynote 1 are the missing piece. Galaxy Digital is a NASDAQ-listed company. It cannot operate in gray areas. The emergence of regulated crypto-native banks and clearer frameworks for tokenized securities provides the compliant rails upon which these giants can now deploy their capital and reputation. They are not jumping into the Wild West. They are building gated, legally sound communities on newly surveyed land. The profound takeaway is that Solana is being engineered into the settlement layer for institutional capital flow. It is becoming the substrate where tokenized treasury bonds from one bank are used as collateral for a loan on a prime brokerage protocol, which funds a trade on a prop am for a tokenized stock, with the whole cycle settling in seconds and visible to all counterparties. This is a level of interoperability and capital efficiency that the current fragmented system of DTCCs, SWIFT, and siloed bank ledgers can scarcely imagine. Therefore, the Solana Maxi label from a firm like Galaxy is not mere hype. It is a strategic allocation of human, financial, and political capital. They are not betting on the price of Sol. They are betting that Solana's technical architecture, its speed, low cost, and growing client diversity is the optimal foundation upon which to rebuild their own business models and, by extension, the future of finance itself. They are no longer visitors to the ecosystem. They are its most powerful new tenants constructing monumental buildings. Their presence validates the infrastructure for every other builder and signals that the age of institutional adoption is not a vague someday. The blueprints are approved, the ground is broken, and the construction, as Breakpoint proved, is already underway. The flow of institutional capital is no longer a question of if, but of how fast, and the how is being coded live on Solana.